There is a particular silence that falls over the market when Bitcoin loses half its value. It's not the loud excitement of a bull run or the confident debates you hear when prices are climbing. It's a heavy, uneasy quiet mixed with panic headlines, red charts, and a flood of voices saying the same thing. This time, it's over. For anyone new to the space, a 50% drop doesn't just look like a correction. It feels like a collapse of belief itself. I remember the first time I watched Bitcoin fall that hard. At first, I kept refreshing the charts every few minutes, convinced that the next candle would reverse everything. But it didn't. Each drop made my stomach tighter, and every news article seemed to confirm my worst fears. Friends who had been bragging about crypto weeks earlier suddenly went quiet. Some swore they would never touch it again. And deep down, I wondered if maybe they were right. Maybe I had misunderstood everything. What makes a 50% drop so psychologically brutal is not just the loss of value. It's the speed. Prices fall faster than our minds can adapt. When we see numbers shrinking day after day, we don't interpret it as volatility. We interpret it as danger. Our brains are wired to react strongly to loss, far more than to gains. The fear of losing what we already have overwhelms the possibility of future growth. So even people who believed in Bitcoin at higher prices suddenly begin questioning whether they ever believed at all. Social media amplifies this effect. When prices rise, timelines are filled with confidence and bold predictions. But when prices crash, the same platforms become echo chambers of fear. Charts predicting further doom spread faster than any balanced analysis. Influencers who once sounded optimistic begin sounding cautious or defensive. The emotional contagion is real. You don't just feel your own fear, you absorb everyone else's fear too. This is why most people instinctively pull back when Bitcoin drops by half. They stop buying. Some panic sell. Others freeze completely, unsure what to do next. And on the surface, that reaction seems rational. Why would anyone want to buy something that is falling so aggressively? Why step into a market that feels unstable and uncertain? But here's the twist that experienced investors quietly understand. Markets often feel most dangerous at the exact moment when long-term opportunities begin forming. A massive drop doesn't just reflect fear, it reflects a shift in who remains in the market. Speculators who chased quick profits often disappear during these periods. Leverage gets flushed out. Excess hype fades. What remains is a quieter, more grounded environment where prices begin to reflect patience rather than pure excitement. If you look back through Bitcoin's history, you'll notice something uncomfortable but undeniable. Drops of 30%, 50%, even more have occurred multiple times. Each one felt catastrophic in the moment. Each one triggered waves of doubt. And each one convinced a new group of investors that the story was over. Yet over longer stretches of time, those same moments became the starting points for future growth phases. Not because the market magically recovered overnight, but because fear eventually gave way to renewed conviction. The real difference between those who later benefited and those who walked away wasn't intelligence or luck. It was perspective. Instead of seeing a 50% drop as proof that Bitcoin was broken, some investors saw it as a natural phase of a highly volatile emerging asset. They stopped trying to predict the exact bottom. They stopped obsessing over short-term price swings. And they began focusing on a simple idea. If they believed in the long-term potential, perhaps the smartest move wasn't to run from volatility, but to approach it with a structured plan. That shift in thinking doesn't happen overnight. It usually comes after painful lessons. After realizing that selling during extreme fear often locks in losses. After noticing that trying to time perfect entries leads to constant hesitation. And after accepting that no one consistently predicts market bottoms with accuracy. Once that realization sinks in, the question changes. Instead of asking, "Is this the bottom?" investors begin asking, "How can I participate without relying on perfect timing?" That's where the concept of dollar cost averaging quietly enters the picture. Not as a magical solution, and certainly not as a guarantee of profit, but as a way to transform chaos into consistency. Rather than making one large, emotionally driven decision, investors start spreading their entries across time. They turn volatility into a process instead of a gamble. In moments when Bitcoin drops 50%, this approach becomes especially powerful because it reframes the situation entirely. Instead of viewing the market as a collapsing structure, you begin to see it as a fluctuating environment where lower prices are simply part of the journey. The fear doesn't disappear overnight, but it becomes manageable. The focus shifts from reacting to headlines to following a personal strategy. And maybe that's the most important mental transition of all. A 50% drop feels like the end only when you believe that every decision must be perfect and immediate. But when you step back and view the market through a longer lens, those same moments start to look less like disasters and more like turning points. Not because the pain is imaginary, but because volatility is the price of admission for assets that have the potential to grow dramatically over time. So before we even talk about numbers, strategies, or historical charts, there's a deeper realization that needs to happen first. A crashing market is not just a financial event, it's an emotional test. And the way you respond during those moments often determines whether you walk away empty handed or quietly begin building something meaningful while everyone else is too afraid to start. If you stay in the Bitcoin space long enough, you begin to notice a strange pattern. Every cycle feels unprecedented while it's happening. Every crash feels final, and every recovery seems impossible until it isn't. When the market drops 50%, people start searching for reasons why this time is fundamentally different. Maybe regulations are coming. Maybe institutions are leaving. Maybe the technology has peaked. The narratives change with each cycle, but the emotional rhythm remains surprisingly consistent. Years ago, when I first began studying Bitcoin's price history, I expected to see a smooth upward curve. Instead, I found a landscape filled with violent corrections. There were drops so severe that if you only looked at short time frames, you would assume the entire experiment had failed. Yet when you zoomed out, those same moments became small waves within a much larger upward trend. It wasn't a straight line. It was a series of surges and collapses, optimism and doubt, belief and fear constantly battling for control. One of the most fascinating things about these cycles is how predictable human behavior becomes. During the early stages of a bull run, excitement grows slowly. People are cautious at first. Then confidence builds. Prices rise faster. Suddenly everyone feels like a genius. Eventually the market becomes overheated. Expectations become unrealistic, and leverage floods in. And when reality finally interrupts the euphoria, the crash feels shocking, even though the conditions for it were quietly forming for months. After a 50% drop, many investors instinctively look for the perfect moment to jump back in. They wait for confirmation. They wait for stability. They wait for someone to tell them the bottom is in. But markets rarely provide clear signals. Instead, prices move unpredictably, bouncing up and down, trapping both optimists and pessimists. People who try to time exact entries often find themselves stuck in endless hesitation. If the price falls further, they wait. If it rises slightly, they fear they've already missed the opportunity. This is where dollar cost averaging starts to make sense, not as a reaction to fear, but as a response to uncertainty itself. Rather than trying to solve the impossible puzzle of perfect timing, investors begin allocating smaller amounts consistently over time. The idea isn't to outsmart the market. It's to participate in it steadily, regardless of whether the next move is up or down. Imagine two investors facing a major Bitcoin crash. One spends months analyzing charts, convinced they can identify the absolute bottom. They wait for a final capitulation signal that never looks convincing enough. Meanwhile, the other investor accepts that predicting exact turning points is nearly impossible. Instead of making one big decision, they start buying gradually at regular intervals. They don't know whether prices will drop further, but they understand that lower prices across time reduce their average cost. Over multiple cycles, history has shown that this consistent approach often produces surprising results. Investors who tried to be perfect frequently ended up doing nothing during the most important periods. Those who practiced steady accumulation during fearful markets gradually built positions that benefited from later recoveries. Not because they were fearless, but because their strategy allowed them to act despite uncertainty. There's also a subtle psychological advantage hidden inside this method. When you invest gradually, each market drop stops feeling like a personal failure. Instead of watching your portfolio shrink and feeling helpless, you begin to see falling prices as part of the process. The market's volatility transforms from an enemy into a mechanism that works in your favor over time. You're no longer trying to guess tomorrow's price. You're building exposure across a wide range of prices. Of course, history is never a guarantee. Just because Bitcoin recovered from past crashes doesn't mean future outcomes are predetermined. Markets evolve, technologies change, economic environments shift. But what history does provide is context. It reminds us that extreme fear has appeared repeatedly throughout Bitcoin's journey. And in many cases, the people who maintained disciplined accumulation during those fearful periods were the ones who later found themselves in stronger positions. Another lesson from past cycles is that patience often matters more than precision. Many investors obsess over entry points while ignoring the role of time. Yet when you examine long-term performance, duration frequently outweighs timing. Being consistently invested across multiple phases of the market tends to matter more than catching one perfect moment. DCA aligns naturally with this reality because it prioritizes presence in the market rather than perfection. As you begin to connect these dots, the narrative around a 50% drop starts to change. Instead of seeing it as a unique disaster, you begin to recognize it as part of a recurring pattern. The emotional chaos remains real. The uncertainty remains uncomfortable. But the historical perspective offers something powerful: the understanding that massive declines have often been the periods when long-term strategies quietly outperformed short-term predictions. And perhaps that's the most important takeaway from looking backward. The purpose of studying history isn't to find reassurance that prices will always recover. It's to recognize the consistency of human reactions to volatility and to learn from the behaviors that proved sustainable over time. When fear dominates the market, the temptation is to either flee entirely or gamble on perfect timing. Yet history suggests there is another path, a slower, more deliberate approach that acknowledges uncertainty instead of trying to conquer it. As we move forward, the conversation naturally shifts from what happened in the past to what happens inside the investor's mind during these moments. Because even when you understand history, fear doesn't disappear automatically. The real challenge lies in managing emotions while executing a consistent strategy. And that's exactly where the deeper psychological strength of DCA begins to reveal itself. Understanding Bitcoin's history can change your perspective, but it doesn't magically erase fear when prices are falling fast. Even experienced investors feel that internal tension when a market drops 50%. You open your portfolio and see numbers shrinking. Your brain starts whispering questions that sound logical but are rooted in emotion. What if it keeps falling? What if this time is different? What if you're the last one still believing in something everyone else has abandoned? This is where the conversation shifts from charts and history to something more personal: human psychology. Because most investment mistakes aren't caused by a lack of information. They're caused by emotional reactions to uncertainty. When markets are rising, confidence grows naturally. But when markets crash, our instincts push us toward self-protection. We become hyper-focused on avoiding further pain rather than thinking clearly about long-term opportunity. One of the most powerful forces at play during a major downturn is loss aversion. Studies in behavioral finance show that people feel the pain of losses more intensely than the pleasure of equivalent gains. That means a 50% drop doesn't just feel like a temporary setback. It feels like a threat to our sense of control and competence. We begin questioning our decisions, our intelligence, and even our identity as investors. At the same time, social pressure amplifies the fear. When everyone around you is panicking, it becomes emotionally exhausting to stay calm. Conversations shift from curiosity to blame. News outlets highlight worst-case scenarios. Analysts compete to produce the most dramatic forecasts. Even friends who once encouraged you start warning you to get out before it's too late. The environment becomes emotionally heavy, making it harder to think independently. This is exactly why many people buy at the top and sell at the bottom without realizing they're repeating the same pattern. When prices rise, excitement creates momentum. Nobody wants to feel left behind, so they enter the market when optimism is highest. But when prices collapse, fear creates urgency. People rush to exit just to stop the emotional discomfort. The cycle isn't driven by logic, it's driven by the human need to align with the dominant mood of the moment. Dollar cost averaging offers a quiet but powerful antidote to this pattern because it introduces structure into an environment dominated by emotion. Instead of relying on willpower during moments of stress, you rely on a predefined process. You remove the need to make dramatic, all or nothing decisions in the middle of chaos. Instead of asking yourself whether today is the perfect day to buy, you follow a rhythm that continues regardless of short term price swings. There's something surprisingly calming about this approach. When the market drops and you know you have a consistent plan, your focus shifts. Instead of reacting impulsively to every headline, you observe the market with a different mindset. Volatility becomes less personal. You're no longer trying to prove that your last decision was correct. You're simply continuing a process designed to unfold over time. Another psychological advantage of DCA during major downturns is that it reframes falling prices as part of accumulation rather than destruction. When prices drop, your next scheduled purchase happens at a lower cost. Instead of feeling like a victim of market movement, you start feeling like a participant in a long-term strategy. The fear doesn't disappear completely, but it becomes more manageable because each drop has a defined purpose within your plan. Of course, it's important to acknowledge what DCA is not. It's not a shield against losses. If the market continues falling for an extended period, your portfolio may still decline in the short term. It's not a guarantee of success, and it's not a substitute for research or risk management. But what it does offer is a way to align your behavior with your long-term beliefs, even when your emotions are screaming for you to do the opposite. There's also a deeper psychological transformation that often occurs over time. Investors who adopt DCA during volatile periods frequently report a shift in how they perceive the market itself. Instead of feeling like they're constantly chasing opportunities, they begin to see themselves as steadily building a position. The emphasis moves from predicting price movements to cultivating discipline. And discipline, more than prediction, becomes the foundation of sustainable investing. Many people assume that successful investors possess extraordinary confidence or fearless personalities. But in reality, many of them simply have systems that protect them from their own emotional impulses. DCA is one of those systems. It acknowledges that humans are not perfectly rational creatures. We feel fear, we doubt ourselves, we hesitate. And instead of trying to eliminate those emotions entirely, it creates a structure that allows progress to continue, even when emotions fluctuate. When Bitcoin drops 50%, the psychological battle becomes more intense than the financial one. The real challenge isn't analyzing the market, it's managing your own reactions to it. The investors who survive and grow through these periods are rarely the ones who predict every move correctly. They're the ones who develop habits that keep them engaged without being overwhelmed. And as you begin to master that internal balance, a new perspective emerges. You realize that the market's volatility is not just testing your capital, it's testing your consistency, your patience, and your ability to act according to a plan rather than a feeling. In the next part, we'll step back even further and explore what all of this means from a long-term perspective, how a massive drop can transform from a moment of fear into a foundation for future financial growth when viewed through a broader lens. After you've lived through a major market crash and learned to manage the psychological storms that come with it, something shifts in how you see Bitcoin and investing in general. The daily price stops feeling like a verdict on your intelligence or your future. Instead, it becomes a small piece of a much larger narrative, one that unfolds over years rather than weeks. And it's within that broader perspective that a 50% drop begins to look less like a catastrophe and more like a moment of repositioning. The most important transformation that happens in long-term investors is not financial, it's philosophical. They stop asking, what will Bitcoin do next month? And begin asking, what role could this asset play over the next decade? That single shift changes everything. Short-term volatility becomes background noise instead of the main story. The focus moves from chasing rapid gains to steadily building exposure to something they believe has long-term relevance. Bitcoin itself exists within a constantly evolving landscape of technology, finance, and global economics. Some people see it as digital gold. Others see it as a hedge against monetary instability or a new form of decentralized infrastructure. Regardless of the narrative you personally resonate with, one thing is clear: the asset's journey has never been smooth. Growth has come in waves, interrupted by dramatic declines that forced investors to confront their assumptions again and again. This is why the long term mindset pairs so naturally with dollar cost averaging. When your horizon stretches years into the future, the exact price you pay today becomes less significant than your ability to remain consistently invested through multiple phases of the market. Instead of trying to maximize every entry point, you prioritize durability. You create a process that allows you to continue participating whether the market is euphoric or fearful. During a 50% drop, this approach reveals its quiet strength. Most people become paralyzed by uncertainty. They wait for clarity that never arrives. They tell themselves they will buy once the trend reverses, only to hesitate again when prices begin rising because they fear buying too late. Meanwhile, those following a disciplined accumulation strategy continue their steady rhythm. They don't claim to know the future. They simply refuse to let uncertainty stop them from executing a plan built around long-term conviction. But a mature long-term perspective also requires honesty about risk. Bitcoin remains a volatile and evolving asset. There are no guarantees about future performance. A responsible strategy acknowledges this reality by emphasizing sustainability over excitement. That means investing only what you can emotionally and financially handle, maintaining balance within your broader financial life, and recognizing that even long-term strategies involve periods of discomfort. What often surprises people is how much personal growth occurs during extended market downturns. When prices are rising, confidence feels easy and effortless. But when the market falls dramatically, you're forced to confront deeper questions. Why are you investing in the first place? What do you actually believe about the future? Are your decisions driven by thoughtful conviction or by the need for validation from others? A 50% drop doesn't just challenge your portfolio, it challenges your clarity. And in that challenge, many investors discover something powerful. They realize that wealth isn't built through moments of perfect timing, but through habits repeated consistently over long periods. They begin to appreciate the quiet discipline of showing up again and again, even when the outcome is uncertain. They understand that financial progress often feels slow and unremarkable in the moment, only becoming obvious when viewed in hindsight. Over time, the narrative surrounding massive drops begins to evolve. Instead of remembering them solely as painful experiences, long-term investors start seeing them as defining chapters in their journey. These were the moments when they learned patience, when they refined their strategies, when they stopped chasing hype and started building foundations. The emotional intensity of those periods becomes part of their resilience rather than a reason to retreat. There's also a deeper realization that emerges once you've experienced multiple cycles. Markets will always fluctuate. New fears will always appear. Every generation of investors will face moments that feel unprecedented. But the core principles of disciplined accumulation, emotional control, and long-term thinking remain remarkably consistent. A 50% drop viewed through this lens is not a unique disaster. It's one of many turning points that test whether you're investing for the next headline or for a future you're patiently constructing. And perhaps the most empowering part of this journey is recognizing that you don't need extraordinary brilliance to navigate it successfully. You don't need to predict the exact bottom or outperform every trader. What you need is a clear vision of why you're investing, a realistic understanding of risk, and a system that allows you to continue moving forward even when emotions fluctuate. Dollar cost averaging becomes more than a technique. It becomes a philosophy of steady progress in an unpredictable world. As this chapter closes, the central message comes into focus. A 50% drop feels like a breaking point because it strips away illusions of control and certainty. But for those who choose to view it differently, it can also become a starting line, a moment when speculation fades and intentional action begins. Not a guarantee of success, not a promise of easy profits, but an invitation to build something meaningful through patience and consistency. While others may step away during periods of fear, some investors quietly continue their journey. Small purchases, repeated over time, guided not by the noise of the moment, but by a vision that extends far beyond it. And years later, when they look back on the periods that once felt terrifying, they often realize those were the very moments when the foundation of their future was being laid, one steady step at a time.